Our next guest says that July is likely marked the peak of the Fed's rate hiking cycle. Gurpreet Gill is the global fixed income strategist at Goldman Sachs Asset Management. She joins us now live from London. It was a fascinating discussion throughout the course of the morning here on CNBC about just how important the CPI read was. One data point does not an overall trend make. But do you feel as though anything has fundamentally changed about the U.S. economic story with this particular CPI print?
Hi, well, first of all, thank you for having me on the show. I'd say the key takeaway is that this CPI data does continue the disinflation trend that we saw in June. And when we make that assessment that July may have marked the peak in the Fed hiking cycle, it's based on a totality of data. And to just emphasize, that is the terminology that Chair Jay Powell used during the press conference. He said, what the Fed does in September is going to depend on the totality of data between the June meeting and the September meeting. And since then, we've had an employment cost index for the second quarter, which decelerated. We've had a jobs report that was mixed, but other measures, such as the jobs workers gap, is narrowing and consistent with rebalancing of the labor market. And today's CPI data also confirms that disinflation trend. So all of that leads us to believe that come September, the Fed isn't going to see a case to hike, and actually come November, you will have accumulated sufficient evidence for the Fed to conclude that July was the peak. I would also emphasize that the Fed doing nothing at this point is actually the Fed doing something. And that is because policy rates are restrictive. So if the trend of disinflation continues, real rates are rising, and that's going to tighten monetary conditions and actually help reinforce that disinflation trend.
Hi, Gurpreet. It's Josh Brown. Thank you so much for joining us. The 10-year yield right now is the lowest yield on the curve, about 4%. The 1 year is 5.3%, which I am telling people, grab as much of that as you can while it's still there. But steepening has been the story this summer. At what point do you think we get out of inversion? Is that a 2023 story, or do we have to wait into 2024? How much longer can we really sit with this inverted yield curve with a healthy economy and inflation moderating to the degree that it has?
That's a great question. We are actually positioned for the US yield curve to steepen in the forward space on the basis of the economic backdrop. And so we do hope it is a 2023 story. Actually, when we came into the summer, we thought that rates for now would be range bound because we thought evidence of disinflation would cap the extent to which yields rise. By the same token, strength in the economy would cap the extent to which yields fall. But we still think that if disinflation continues, the labor market remains resilient, and the economy remains resilient, there is room for the yield curve to steepen from the current very flat levels. I would also just caution that over the summer, thin trading liquidity can distort market moves. And there's lots of factors this summer or this past week or so that has influenced what's happened with US Treasury yields. We had rating actions against US sovereign debt and US regional banks. We had the Bank of Japan meeting, which led to broader term premium repricing in markets. And just big picture, you've seen markets price in this optimism around a soft landing and the fact that the Fed's cycle has peaked.